Hey guys, this is Alex Owari from ONG Tax and Accounting Services. So in this video, we're going to talk about S Corp, and the purpose of this discussion or this video is to help you make sense of the distinction between an S Corporation owner's basis, an S Corporation share of profit that's given to shareholders, wages that the S Corporation pays to you as the shareholder, and then also the distributions that you take. These four items basically confused a lot of S Corp owners or S Corp shareholders. And I have come across several situations where even successful investors, successful shareholders, and people that are doing very well with their businesses and their S Corps really struggle to understand the basic differences between the owner's basis, their share of the profit, the wages, and distributions. Before we start, I would say that this video is for educational purposes only, and it's not meant to be a legal or tax advice. And at any point in time, if you need a legal or tax advice, you need to consult an attorney or a CPA who's going to help you figure some of these things out. Now, if you're watching me, chances are that you own an S Corp and you really don't know how these distinctions work, between the basis, share of profit, wages, and distribution. So the goal here is to use some easy or some simple examples to help you make sense of all of these elements that you have in an S Corp. So in this video, we're going to go through some basic fact pattern. Okay, we're going to tell you a little bit of a story on how all of these things comes together on using the 1120S, which is the S Corporation tax form. We're also going to use the K1 to show you where certain items go. We'll use the 7203, which basically it's used to track your basis. And then we'll also use your balance sheet, which also helps you in tracking out what your basis is and what the asset and liabilities and equities in the S Corp is. So this one is going to be a very simple one. So we'll start laying out the facts. Now, what I have here is a fact that says that Tom sets up an LLC and elected for the LLC to be treated as an S Corporation on January 1, 2021. So this is all good. On the same day, January 1, 2021, Tom transferred $100,000 to the S Corporation in exchange for the 100% stocks in the S Corporation. We started dealing with numbers here, okay? So number 2 here tells us, the second fact that we have here tells us that you have this guy called Tom that set up an LLC and then elected to be a S Corporation. Now, on the same day, he transferred $100,000 to the S Corporation to purchase the S Corporation stocks. So basically what he did is he took money from his personal account or from whatever personal sources that he have to fund the business in exchange for stocks. So he basically purchased stocks in his own company that he's formed. It's no different from purchasing a stock in Apple or Amazon or anything like that, any other company. But in this case, he sets up his own S Corporation and then he purchases a stock in it. And that becomes his capital contribution or equity. Now, when we enlarge this a little bit, we'll show you how this looks like when we look at the facts. When an owner transfers money in exchange for stocks, that transfer is not considered as income. So in this case, Tom transferred money to purchase stocks. The S Corp gets that money, and the way the S Corp enters it on the balance sheet or on its books is that it's going to credit 100,000 as equity or common stocks, and it's going to debit the bank account 100,000. So that all looks good from here. So whenever an owner transfers money to fund the business, it is not income. So that's the first thing we need to put out there. Also, as you can see, when you look at form 7203, this is where we use to report the basis. Now, the money he actually used to purchase the stocks in this S Corporation also goes on form 7203. It increases his basis. So when you look here, on line 2 of your 7203. It will show you basis from any capital contribution made or additional stocks acquired during the year. And we know he transferred 100,000 in exchange for the stock. So the same 100,000 you see here, it's going to be the same you would obviously see on the corporation's balance sheet on line 22, which is being captured as capital stocks for the purpose of this example. Now let's look at the third fact that we have here. Fact number 3. On March 31, 2021, the S Corp completed a service contract for which it was paid 100,000. So it looks like the S Corp has really taken off. It's now servicing contract and getting business here and there. And it's as of March 31, 2021, the S Corp has made $100,000 in gross revenue. So how does this all play out? Now, when you look into the S Corporation's tax return, when you go on the 1120S and you look into line 1, you're going to see your gross receipt or sales to be 100,000. Okay. So everything looks good here for now. This is 100,000. And, if you have other type of items like cost of goods sold and, other income, then you add it. But for simplicity's sake, we're using these simple numbers, 100,000, just, for service contract purposes. So we're using 100,000 for now. So this all looks good. On September 31, 2021, the S Corp paid Tom 50,000 as reasonable compensation reported on W-2. Now, we also know that when you own an S Corp, one of the things you need to be very concerned and up to date with is making sure you as the owner or the shareholder employee who's actively conducting business with this S Corp and working for the S Corp is taking reasonable compensation. And that compensation should be reported on W-2. So basically, you as the S Corp shareholder needs to set yourself up, or the company needs to set you up on payroll reporting. So for example, if you want to set up payroll, you have to register, get payroll tax account from the state, wherever state you're in. You're going to get all those tax accounts, and then you set yourself up on payroll. So in this case, let's assume that Tom and his S Corp did everything right. They set up payroll, and on September 31, 2021, the S Corp paid Tom 50,000 as reasonable compensation, and it was reported on W-2. Now, when you look on your 1120S line 7, you're going to see compensation of officers 50,000. We know two things now. We know that there's a gross revenue of 100,000 and there's a reasonable compensation of 50,000. Now that brings your ordinary business income or losses to 50,000. In this case, we don't have losses. We have gain or profit. So there's 50,000. If you're here with me, just follow me. It gets easy. This 50,000 here, you as a shareholder picking up this income, you will pick it up on your W-2 and then you report it as an income to you. This is income you earn as a W-2 or an employee for your own S Corp. So this 50,000 will be reported on your personal tax return. And at the end of the year, the S Corp is going to send you a W-2 showing this amount. If you're paying too much attention to this tax return, you would realize that we did not expense any payroll taxes, because ordinarily the company should pay some payroll tax when they pay an employee. But the focus of this video is to make things easy. We're not trying to bring in complicated issues. So let's just stick with simple fact. For the purpose of this video, we're just disregarding those payroll taxes for now, just to make the numbers clear and clean. So now you have the officer who took out compensation of 50,000. This will be reported on W-2 at the end of the year. And then when you back out this W-2 expenses from the total gross receipt, the company actually made 50,000 in profit. To the shareholder, what does this 50,000 means? An S Corp, basically, this income here is reported on K1. So the shareholder, when you follow this line here on K1, you see that the shareholder, Tom, has all his information on K1. Now, this 50,000 is going to be reported on the shareholder's tax return. Now, this income, and it's quite good that we're talking about this one today, because just before recording this video, someone actually asked me if this residual income or profit is subject to self-employment taxes. And the answer is no. This income is basically seen as ordinary dividend and it's not subject to self-employment taxes. This is why most people will set up an S corp and they sometimes get themselves into trouble when they pay themselves lower or they pay themselves unreasonable compensation just to make sure that they are not paying too much taxes on their FICA taxes. Because this here, your wages here attract FICA. So you as an employee pays 50% of FICA taxes on this 50,000, and then your employer also pays 50%. Now, some S corp shareholder employees decide that, look, I'm paying too much FICA, so I'm going to reduce this so that I can get more income here, so I can basically override those FICA taxes or not pay it at all. But it is not a good thing to do. If you own an S corp, you need to pay yourself reasonable compensation. And what does reasonable compensation means? It depends. It's not something that anyone can just sit somewhere and tell you, hey, you make this money, so pay yourself reasonable compensation. Facts and circumstances needs to be reviewed to figure out how much of your income you're receiving from this S corp should be assigned to you as reasonable compensation. And now that we have that out of the way, so far we know Tom received 50,000 in wages. After all the expenses is taken out, he is also going to get 50,000, which is going to be reported on his K1. So the K1 here is going to show 50,000. And this is what he also reports on his personal return as ordinary income. So this does not attract self-employment taxes. So someone asked me this question and I was like, okay, I get why you guys have this confusion, but this income, your residual income or allocable share of income that's assigned to you as a shareholder of an S corp is not subject to self-employment taxes. There's any self-employment taxes you need to pay. And even because you're an employee, you don't pay self-employment taxes. You pay the FICA taxes, which is basically similar to self-employment taxes, but we call it FICA because your employer pays 50% and then you pay 50% of the FICA taxes. And it's usually 15.3%. So when you strike it by 2, your employer pays half and then you pay half. Okay, so now we have this. We have the 50,000, which is the ordinary business income that Tom has made. We know that it's reported on K1. This 50,000 is also reported on other places. Now, remember we told you that you also need to know your basis. So we're building up your basis. You know that we started with 100,000, which is your capital contribution. And then now we have 50,000, which is ordinary, which is on line 3A, ordinary income, business income, which is 50,000. When you add 100,000 plus 50,000, it becomes 150,000. So far, Tom's basis is actually 150,000 here, as you can see. So we're building up the basis. So far, we know we've dealt with 3 elements. We've dealt with basis. We've dealt with wages of the S corp shareholder or shareholder employee, as we like to call it. We've also dealt with ordinary business income and how it's treated. All right, so now let's look at what happened on December 31, 2021. Tom distributed or transferred 50,000 from the S corp to his personal account. So the plot gets thicker. Things gets complicated from here. But really, it's really not a problem because if Tom has distributed or transferred 50,000 from the S corp to his personal account, it basically decreases his basis. It has no impact on the financial statement here. It has no impact on the 1120S page 1 we have here. It is simply distribution that reduces your balance sheet account. Okay, so let's go and look at how the distribution looks like. So whenever the shareholder takes a distribution, one of the questions they ask is, hey, I took 50,000 out of my S corp. Am I going to pay taxes on it? Once again, The answer is it depends on whether you're going to pay taxes on it or not. Whenever you take distribution out of your S corp, what you need to think about is your basis. Okay, don't think about any other thing. Think about what your basis in the company is. And that would determine whether you're going to be taxed on the distribution or not. And if you happen to be taxed on it, it will be taxed as capital gains. Okay, so if you've held the stock for less than a year, then it becomes short-term capital gain. If it's more than a year, then it becomes a long-term capital gain. So in this fact pattern, Tom has distributed or taken out money, 50,000 as distribution from his S corp. So the question is he going to be taxed on that distribution? Here's where the basis is very important. Now, you remember when we started building the basis from when Tom contributed capital. So when he contributed the capital, we have the 100,000 contributed. It's also showing on 7203. And then you also have the ordinary business income. Now, if it's ordinary business income and it's not losses, it increases your basis. So this 50,000 plus 100,000 becomes what? 150,000. So far, we know that Tom has 150,000 in basis. Now, this is out of scope, but assuming this was a net loss or a loss, it would have decreased your basis to 50,000. But in this case, we have a gain. So your basis is basically increased by what you contributed plus the income, your share of the income that you're going to be paying taxes on, 50,000. So we add this plus that gives us 150,000. Now, why do we add this to your initial contribution? That is because we want to make sure you're not being double taxed, because the income here on line 1 of your K1 is going to be taxed. We want to make sure when you take out that same income, subsequently take it out, it's not going to be taxed. So we add this, your initial contribution plus your ordinary income becomes 150,000. So now we know your basis is 150,000. Now the distribution you took, 50,000, is reported on line 6 here. Now this distribution is going to reduce your basis. So remember I said whether you're going to pay taxes on distribution or not, it depends on the circumstances. If your distribution is lower than your basis, then there's no taxes to pay. If the distribution exceeds your basis, then you pay taxes on the difference as capital gains or losses. Now, here's what you have here. You have basis of 150,000. You took out 50,000 as distribution. Okay, good. 50,000 is less than 150,000. So there's not going to be any taxes on this 50,000 that you took. So that means that, your basis reduces to 100,000. And then at the end of the year, you end the basis at 100,000. So it's just as simple as that. One would ask me, why do we show cash 100,000? It's pretty easy. Think about it. Start from the beginning. When Tom started this business, he contributed 100,000 to it, right? Now add the 100,000 from the gross sales he made, which is 200,000. So when you add 100,000 capital contribution plus 200,000, all of them went to the bank account. Now, what really reduced the bank account to 100,000? We know that Tom paid himself 50,000 in W-2 wages, so that reduced it to 150,000. And then Tom subsequently took out 50,000 in distribution. So that also reduces the bank account to 100,000. So in simple terms, this is why you have 100,000 here. And this is why you have 100,000 here. Now, retained earnings is 0. Retained earnings has nothing because of why? When you look at the profit we have here, the ordinary profit is 50,000. Now, because he took out the distribution of 50,000, now when you take out the 50,000 from that 50,000 here, you have retained earnings of 0. That's why you don't have anything here. But there's a whole lot of adjustment you could do to M2, schedule M2 and M1 to arrive at these numbers here. But the point I'm trying to make here is to help you figure out the differences between basis, shareholder share of profit, wages, and distribution. So let's recap. When you have a company, you as a shareholder pays yourself. When you have an S corporation, in this case, we're dealing with S corporation. When you pay yourself, it goes on W-2. So you're not going to see that payment you paid yourself on the K1. It's not going to reflect here. So you have that $50,000 on the W-2. And then once everything is done at the end of the year, your ordinary business profit or losses will be shown on line 21. Now that line 21 goes on your line 1 here on your K1. That also becomes your income. That also is an income that's being taxed to you. So when we think about it, Tom is going to pick up W-2 income of $50,000. Is going to pick up this ordinary business income of $50,000, which sometimes some people refer to it as ordinary dividends. And so you're going to pay ordinary income taxes on it. But this does not attract FICA taxes or self-employment taxes. It's simply taxed at ordinary income rates. Your K1 is also going to show so many stuff. Because it's the S Corp does not pay its own taxes. It's just, we just file an information return and then we passes everything through to the S Corporation shareholder. So if you have a very sophisticated return, you're going to see so many type of income that is being passed through to you. But in this case, we only dealt with service income, and it turns out to be ordinary business income. And so that's what you have here. And then in this case, we have some facts that shows that the business owner took $50,000 out of the company as distribution. We also have the 7203, which helps you to build your basis. And this is very important. This 7203 is important when you have losses, because when, as an S Corp owner, you cannot take more losses than you have invested in the company or than your basis, right? So one example I can give you here. Let's say you have basis of 100,000 and then you have losses of 150,000. You cannot take all the losses. You have to limit your losses to your basis in the company. But let's not confuse you on this, because when it comes to losses, it can be very complicated. The example we have here is assuming you have gains and then you've taken out distribution. Whether distribution is going to be taxed or not, it depends. If the distribution is lower than your overall stock basis, then there's no taxes on that distribution. You take it tax-free. If that distribution is higher than your basis, then the difference between the distribution you took and the basis becomes a capital gain to you. So it's just as simple as that. So getting to know what your basis is, how your wages from the S Corp is treated, how the ordinary income pass-through is treated, and then how your basis works when you take distribution is all important. I hope that this helps you guys out. For those of you that are still confused about some of these complicated issues with S Corp, I hope this helps you out. And if you have any questions, please feel free to use the link below and book an appointment with me, and we can talk more about you and your S Corp and any other issues that you may have surrounding your S Corp. Thank you. Bye.